Good morning. Thank you for joining us at today's session. My name is Adam Goldstein. I'm the Chief Business Officer at the Federal Home Loan Bank of New York. Just want to go over a few quick notes before we get started. Today's webinar will be conducted by Tom Citino, our Vice President, Director of Member Relations, and Brian Jones, our Financial Economist. Our title is Looking Ahead to the Great Reopening. Who would have thought that such a game changer like COVID-19 pandemic would occur to knock the U.S. economy off its tracks? We were in the midst of the longest expansion in U.S. history when COVID-19 appeared. And unlike previous business cycle turning points where serious imbalances often could be predicted in advance, the current health crisis was unforeseen and struck at a devastating speed. And so, with all the uncertainty that surrounds us, we will spend 45 minutes with you to discuss the current economic landscape and explore what's involved in the Great Reopening. If you do have any questions, please submit them at any time through the question box and they will be answered at the end. In an effort to continually enhance the programming that we provide to you, we ask that you please complete the survey, which will come up after the webinar concludes. We value your input and try to cater these sessions to what our members are most interested in. Also, of note, we have created a dedicated COVID-19 information page filled with up-to-date announcements from the Federal Home Loan Bank, including, but certainly not exclusive to, our disaster relief program, which affords our members a variety of diverse options to support local small business, as well as the acceptance of PPP loans as collateral. This was all announced last week and this week, and we've been actively engaged with our members to allow them to have access to these grant programs and also to accept PPP as collateral. Lastly, we invite you to join us next Thursday, May 21st, for the next webinar in our virtual event series, ALM Strategies for Unprecedented Times. For now, though, let's get to our webinar of today, and I'd like to introduce Tom Citino. Tom, take it away.
Okay, thank you, Adam. Good morning, everybody. Thanks for joining us at this webinar. Just want to introduce Brian Jones, our financial economist. Brian has been in the business of being a professional economist for over 3 decades. He's got some really impressive history and experience. He's worked at a variety of leading domestic and foreign financial institutions, including Societe Generale, Citibank, Salomon Smith Barney, when it was just called Salomon Brothers, also Lloyd's Bank, and then Irving Trust Company. And throughout his career, Brian's been supporting all aspects of fixed income, currencies, and commodities businesses of his employers. And he's since recently joined the Home Loan Bank just 3 years ago. So since he's joined the Home Loan Bank, he's been providing us and been a great resource for providing macroeconomic analysis and strategic insights, especially during this crisis. It's been invaluable, all the insight that Brian's been providing to us on a daily basis. And also, he's a great resource for our members as well. He provides macroeconomic insights and also insights to the regional sections or sectors of our FHLBNY coverage area. He's a frequent speaker at the trade orgs and often meets directly with our members to discuss strategy and meet with their board of directors and then also management teams. So with that being said, I'm going to turn it over to Brian. Brian, take it away.
Good morning, Tom. Thanks for the introduction. Good morning, everybody. I figure we'll jump right into the presentation with the next slide. As Adam said, we were in the midst of the U.S.'s longest economic expansion in our history, over 10 years when the coronavirus crisis hit. Basically, the impact on our own economy is really felt more or less when we got to the second half of March, when in response to the healthcare crisis, there was widespread shuttering of areas of the U.S. economy. Essentially, what happened was, beginning in the middle of March, the economy essentially just closed for business. The downturn in the second half of March was so severe that it was able to pull the whole first quarter lower. Growth in the first pass from the Bureau of Economic Analysis clocked in at negative 4.8%. That was the first outright contraction in U.S. economic activity since the winter of 2014, and it also marked the steepest decline in real GDP growth since the fourth quarter of 2008, when we were amidst of the Great Recession. Not only was the first quarter weak, but the problem is the way it laid out is that we have a tremendous amount of negative momentum going into the quarter right now. Right now, if you look at estimates for growth in the economy, depending on which one you want to put stock in, pretty much everybody is looking for a sharp decline in activity over 3 months ended June. Right now, the Bloomberg consensus is looking for a contraction of about 28%, but they are by no means the most pessimistic. The St. Louis Fed has an estimate that's a little bit north of 40%, and even the nonpartisan Congressional Budget Office expects that growth in the current quarter is probably going to be down by about 40% over the April to June span. The thing that I've been looking at more and more to get a handle on what business activity looks like in real time is a measure that the Federal Reserve Bank of New York has recently come up with. It's a weekly economic index that they release both on Tuesday morning and Thursday morning, and it's based on seven weekly real-time series on the economy, and it does a pretty decent job of tracking real GDP growth on a year-to-year basis. Basically, what goes into their measure is Red Book retail sales, which is a measure of same-store sales. Of course, like most real-time measures, they use unemployment insurance claims, which we got this morning. They look at staffing data from the American Staffing Association. They look at gauges of consumer sentiment, such as the Rasmussen Consumer Index, and they look at output measures such as real steel production, also electricity output, and also U.S. fuel sales to end users. The data that we have through Tuesday suggests that we're probably their numbers are consistent with a decline in real GDP growth of almost 36% in the current quarter. The thing that's amazing about what we're going through right now is just the speed with which conditions have deteriorated in the U.S. Typically, when we go into a business cycle downturn, we do get some advance warning. There's a serious imbalance in the economy, and we can get the sense that things may be on the verge of rolling over. To be honest, the way the economy was shut down in the midst of the COVID-19 crisis, it was akin to just flipping a light switch. Basically, the U.S. economy turned right off. And you can see, if you look at the slide on page 5, initial jobless claims just blew out to unprecedented levels, surpassing by a country mile and then some what we experienced in the midst of the Great Recession from 2008 through the middle of 2009. Basically, to date, we've seen since the middle of March, we've seen about 22 million Americans lose their jobs and have to file for jobless benefits. We have never experienced anything like this in our history. If you look at the right-hand side panel on that chart, you see a measure that Claudia Sam, previously of the St. Louis Federal Reserve Bank, came up with to determine business cycle turning points. And her business cycle turning point gauge basically takes the unemployment rate over a 3-month period and subtracts from that the low on the jobless rate over the prior 12-month span. And you can see that basically we went from an economy that was fine right into recession with the data that was released in the last month's report. We've never seen anything like this in our history. I mean, to put the job losses in perspective, the April report that was released a week ago, we lost over 20 million jobs. It wiped out all of the job gains posted over the course of the entire expansion or 10-year period. So, I mean, we've never seen anything like this. This is not just a deterioration of labor market conditions; it's a wholesale collapse. If you look at the next slide on page 6, if you look at the private sector job losses, they were just absolutely staggering in the month of April. We lost over 19 million jobs in the private sector. Pretty much all but a fraction of those were concentrated in service-producing industries, largely leisure and hospitality. and transportation and warehousing. Basically, the industries that have been hit hardest in the midst of this crisis have been those that involved a tremendous amount of social contact. Restaurant jobs, jobs at hotels, jobs in the airline industry. So in some sense, these were the jobs. The magnitude of the job losses in the last month, they were basically determined by how much social contact was involved in whatever industry you were looking at. The service sector, I mean, there are in a variety of industries within the service sector, activities just absolutely collapsed. If you look at airline travel compared to last year, we're down over 90%. There is some sign of hope if you look in the right-hand side of the panel on on slide 7. Hotel occupancy rates, which had cratered, looks like they may have bounced a little bit off their lows over the last 3 weeks. If we look at the restaurant industry, that was another industry that was extremely hard hit. We are starting to see some signs of life in areas that have reopened, primarily the states of Texas, Georgia, and Florida. I mean, certainly sales are, still about 90% below where they were this time last year. But again, they look like they're off the bottom. And if you look at the movie industry, basically nobody's going to theaters right now because of the social contact involved in going to cinema. As far as inflation is concerned, we know that real activity is basically taken a severe hit in the current quarter. On the inflation front, we're seeing some similar evidence of the pandemic as well. The consumer price index numbers that we got for the month of April were much weaker than expected. Now, it was no secret that energy prices were going to be down a lot, basically because of a lack of demand, whether it was basically gasoline prices at the pump have come down quite a bit. Also, broader prices like which would be wholesale prices, but jetliners, jet fuel sales also were down sharply. But if you looked at the detail of the report, there were a variety of other goods and services prices that fell sharply because of a lack of demand. Apparel sales were off. Airline passenger fares were off quite a bit. Used vehicle sales. The one interesting thing, well, not interesting thing in the report, but the one thing in the report that basically was detrimental is that we had a pretty decent size increase in retail food prices. We're up about 1.5% in 1 month, and that was broadly based across pretty much all of the categories. But again, given what the inflation numbers have done in light of the crisis, it looks like inflation is probably not going to be on the radar screen of Federal Reserve officials. It's not going to be an item of concern for probably through this year and probably well into next year. It looks like we're going to end up this year well below, maybe a full percentage point, below the Federal Reserve's 2% target on inflation. The things that have helped us a lot in going through this crisis, and I think in some sense have ameliorated it, is the fact that policymakers have acted very aggressively. The Federal Reserve, not only have they cut interest rates back to the Great Recession low of 0 to 0.25%, but they've enacted a lot of measures to support various sectors of the financial markets. Also supporting us is the fact that Congress and the administration have been very aggressive in putting in fiscal policy measures in response to the crisis. If you look at the slide on page 10, I mean, basically financial conditions did deteriorate sharply in the wake of the COVID-19 crisis, but we are well off our lows, and the lows that we experienced throughout the response to the pandemic, they've been less than half of the deterioration that we experienced during the Great Recession from 2008 to the middle of 2009. So the fact that policymakers have acted aggressively in response to the crisis, I think that is it's prevented basically a free fall in financial conditions which we experienced in the prior business cycle downturn. I mean, in some sense, it's kind of weird calling this a business cycle downturn, because what it really is it's a response to a disaster. It's almost akin to what happens to an economy after you have hurricanes like Katrina or Maria. But the thing that makes it entirely different is the fact is that we just don't know when this thing is going to end right now. But financial conditions have improved recently. Money market and bond market spreads have come in. Bond and equity market volatility subsided, and equity prices have found some support and actually bounced off their lows. Looking at what the Federal Reserve has done in the wake of the crisis, as I said before, I mean, they cut the funds rate to 0 to 0.25%, returning it to the Great Recession low. They've expanded their reverse repo operations. They've restarted quantitative easing in a big way. I mean, QE is one of these things that I think is going to be a permanent item in their toolkit. And the one thing that I was looking at this morning is when we went through the great financial crisis, when the Fed did embark on quantitative easing, it was a period in which Taylor rule calculations for what the appropriate level of the federal funds rate should have been would have been about negative 4.5%. And right now, if you do a Taylor rule calculation, given what's happened with inflation and the massive deterioration of labor market conditions, right now the Taylor rule is saying the federal funds rate should be negative 8.2%. So basically, the fact that the Fed has ramped up quantitative easing, it's basically in response to the fact that the federal funds rate probably should be negative. But again, the Fed has told us time and time again in recent appearances that they have no intention of embarking on any negative rate regime. Also within the Federal Reserve's programs, there were a variety of things that were put in place, programs in concert with the Treasury to support various segments of the financial markets, whether it was commercial paper, money market mutual funds, or corporate credit. I mean, beginning this week, the Fed did start to buy bond ETFs as well. And they also reestablished the Term Asset Securities Loan Facility, or TALF. And they've also introduced other programs to help consumers and Main Street lenders. As far as the Fed's balance sheet, which they started to bring down beginning in 2018, I mean, in the midst of the current crisis and the renewed purchases of securities, the balance sheet has expanded quite a bit, up by about $1.7 billion to a little over $1.7 trillion to a little over $5.5 trillion. And again, this is a permanent tool in their kit now when the economy is rolling over. And I think the thing is, you really do need to take your hat off to the Fed, because they were exceptionally aggressive in the midst of the COVID crisis. They did not wait for it to show up in the data. In fact, they were way out in front of it. And to be fair, as much as it takes a lot longer to get things done in Washington, D.C., I mean, Congress and the administration have been aggressive as well. I mean, basically, we have 4 stimulus packages that they have put in place to date. You can see them listed in slide 13. Basically, the sum total of the programs that we have in place through stimulus pack, the 3.5 program, we've got about $2.6 trillion worth of fiscal stimulus. I mean, in some cases, I'm not quite sure you want to call them stimulus packages, given what's going on. I think I would call them more support packages to try to carry the economy through this current crisis. And basically, the stuff that has been enacted to date represents about 12% of nominal GDP. And chances are there may be additional packages forthcoming. There is talk in Congress of doing something to put in place once again the state and local tax deduction for homeowners. There is also some talk about providing some other support programs to states and municipalities as we go through the crisis. What does this mean as far as fiscal measures? Given what the administration and Congress have done, we are going to see massive deficits going forward over the next decade. The Congressional Budget Office, and again, they don't have an axe to grind, they're nonpartisan. They've recently come out with estimates of what they think the budget deficit is going to be for the next 2 years, fiscal 2020 and 2021. We were expecting deficits averaging about $1 trillion over the next 2 years. Basically now, the CBO estimates under current programs and with the four programs that have been enacted in Washington, that the shortfall is going to be about $3.7 trillion this year. and it'll probably pull back to about 2.1 trillion next year. They've yet to do a full-blown forecast for the whole decade, but I think we can extrapolate out to 2030 that these numbers that we're going to have at the end of the 10-year period are going to be substantially higher than those the CBO was working with in their last full-blown forecast in March 2020. Now, against that backdrop, what's going to happen if you're going to run these massive deficits is you're going to see big increases in the deficit as a percentage of GDP. In this fiscal year, we're probably going to be very close to 18%, and we'll probably be a little bit shy of 10% next year on the deficit. And again, we don't have estimates from CBO going out beyond 2021, but we're easily going to be higher with the deficit as a percentage of GDP than we were in their last full-blown forecast in March. Against that backdrop, what's going to happen is, in order to fund these deficits, you're going to see a massive ramp up in the amount of Treasury issuance and projected debt held by the public. The CBO has yet to come up with forecasts for the levels of the debt held by the public for 2020, 2021, but they do expect, as a percentage of GDP, these numbers they have released, they expect that the deficit is going to go from about 79% of GDP. I'm sorry, the projected debt held by the public is going to go from about 79% of GDP last fiscal year to about 101% this year, and that will climb to 108% of GDP in 2021. As far as interest rate forecasts, I think we need to take them all with a grain of salt right now, because they're basically held hostage to whatever the resolution of this crisis is. But at least going out over the next 15 months, the consensus is that short rates are going to remain pretty well anchored. That they're basically pricing in maybe one increase in the funds rate by the summer of next year. And again, that could be a stretch given the forward guidance that the Federal Reserve has given us, where they've told us they expect to do everything that they can to support the economy, and there's probably not going to be any change in administered interest rate policy until they're absolutely certain that the economy is on a sure footing. But we do have a gradual move up in the yield curve projected by the consensus. Those numbers have come down. That's why I think you need to take these numbers with a grain of salt, because a month ago, the projection for the 30-year bond, last month's forecast was for it to get to 2%. That has since come down to 1.8%. On 10s, the forecast has also moved 20 basis points lower, with the consensus expecting 10-year notes to trade at a yield of about 1.2% in the summer of next year. But again, these numbers, they move every month, and I would take them as indications of what's going on. I mean, where I am in agreement with the consensus is the fact that I think short rates are going to be well anchored by the fact that the Fed's going to be no rush to alter policy anytime soon. And as was the case when we came out of the 2008-2009 downturn, they're probably going to allow rates to remain low for an extended period of time, basically because they're facing an unemployment situation which we haven't seen since the Great Depression, and also on the price front, there's really no evidence of inflation at all. As far as what's going on in our own area, needless to say, like the country as a whole, activity in the Federal Reserve, in the Federal Home Loan Bank of New York District has come off sharply. Manufacturing activity has basically cratered in the month of April. That's no surprise. The one positive thing, though, in the latest surveys that we have from the New York Fed on factory activity in our area is that at least survey respondents remain positive, and they do think that things will be better in the future. But unlike the manufacturing side of the local economy, the service side, I think things they're much more guarded. I mean, certainly a variety of service sector gauges in our district have collapsed as well. But the one alarming thing here is that unlike the manufacturing sector of the local economy, the service sector firms are very concerned about current business activity and the future business activity going forward. And those numbers have gone down almost as steeply as the numbers for the current conditions. As far as the employment conditions in our district, things are, we've taken this thing on the chin compared to the rest of the country. I think primarily because we have so many people that are concentrated in the service sector of the economy, restaurants, hospitality, and things like that. I mean, jobless claims in our district, we're running around we had about 290,000 people on the state benefit rolls in our district in the middle of March. That has since gone up to about 2.7 million. So within the Federal Reserve Home Loan Bank of New York District alone, including New York, New Jersey, Puerto Rico, and the Virgin Islands, we've lost almost 2.5 million jobs over the last 6 weeks. The one area where we might have, that should improve once we do start to come out of this thing, and I'll say a little bit more about how I think we're going to come out of it in a second or two, is the housing sector of the economy. I mean, this housing sector, believe it or not, was doing phenomenally well headed into the COVID crisis. In fact, even with a sharp downturn in building activity in the first quarter, residential investment was up about 21% annualized, and they had almost 3/4 of a percentage point to reported GDP in the first quarter. If you look at pending home sales and existing home sales, that's the right-hand side panel there. I mean, basically, pending home sales were moving up in response to the lower interest rates, and existing home sales follow. Basically, pending home sales, their contract signings, existing home sales are closings. The sharp decline that we saw in pending home sales in the month of March, you probably have to be somewhat careful about that because a lot of the fall off may have been attributable to the fact that with all the social distancing restrictions that have been put in place, people just couldn't get out and look at homes, and it probably extended closing times as well. If you look at what the impact of the crisis is probably going to be on mortgage performance, we did see an increase in delinquencies nationwide. In the last quarter, we went up to about 4.4%. That was off the all-time low of 3.8% in the fall of last year. Foreclosures, they're down at their lowest rate since 1984 at about 0.75%. But you've got to expect these things to pick up as we go into the second quarter. Basically, we have seen increases in forbearance requests as a percent of servicing volumes at Ginnie, Freddie, and Fannie, and other services. It looks like we probably peaked at the end of March, beginning of April. But given what labor market conditions are doing, we still have to keep an eye on these numbers. They may not have bottomed yet. In fact, as of the latest numbers, there are about 4 million loans that are in forbearance. What I think is the most important data to watch on a daily basis, aside from any economic statistics, are the number of tests that we're conducting nationwide every day. And these fluctuate. They're very volatile on a daily basis. And evidently, there may be some reporting problems because some states may be including people that are doing antibody testing. But again, for an economy our size, we probably need to see the tests per day conducted somewhere around 500,000 per day. And that may be the only way that we get the percent positive cases down in a meaningful way in the weeks ahead. As far as how we come out of this whole thing, I think what's most important here is two things. It's how quickly we reopen segments of the economy and how broad the reopenings are. If you use China as a model, you would say that we should come out pretty quickly. So, for example, if we lose, let's say, we lose 40% of output in the second quarter, we should be looking ahead to a bounce back, probably a little bit north of 30%. But the thing is, the structure of our economy and that of China are very different. China is much more heavily concentrated in the industrial sector than the U.S. is. We're much more heavily concentrated in the consumer. The consumer is about 70% of overall economic activity. And we know from the social distancing restrictions that have been put in place, the portion of consumer spending that's been hit the hardest has been services spending. So that may take some time back. The other thing too is that China basically reopened their whole economy en masse in one shot. What we may experience in the United States, and this has both upside and this has some benefits to it, is that we will probably open individual segments of the economy or areas of the economy rather than a full-scale opening, which means that as some areas opening, if they do have a relapse, the relapse will be isolated to those areas. And so if we open the economy up in segments, it actually may be the more prudent way to do things. You can see in our area, for example, the governors of New York, New Jersey, Connecticut, Rhode Island, and Delaware have gotten together, and basically they've decided that if they do have a full-scale reopening, that they're going to try to do it together. And that makes a lot of sense because you don't want to have what I call openness arbitrage, where if one state opens up, activity shifts to the areas where people can go to restaurants and bars and stuff like that at the detriment of other areas. But again, these things are all up in the air. I think the most important numbers as far as economic statistics to look at over the next several weeks will not be the jobless claims numbers, but to look at the continuing claims numbers, because it looks like the jobless claims numbers, they peaked at around 6.6, 6.7 million 4 weeks ago, and they have been coming down. But the key is, even though the number of new filers has come off, the number of people on state benefit rolls continues to rise. And the analogy that I like to use when I look at the jobless, the unemployment numbers, the unemployment insurance numbers, is it's akin to a bathtub. Initial claims is the amount of water going into the tub. Continuing claims are the level of water in the tub. And the only way we reduce the level of the water in the tub is people need to find work, or they exhaust their benefits, and hopefully that won't be the case. That we've got more than enough weeks benefits available. The one thing, the last chart that I'd like to just point out is what happens. I mean, our own activity may actually be a leading indicator that the worst is behind us. If you look at the Federal Home Loan Bank of New York advances, their trend, their gap from trend compared to financial stress measures. I like to use the Kansas City Financial Stress Index. You can see that after our advances peaked, they're at least in the financial crisis of 2008, 2009, they were a leading indicator that we were about halfway through when they started to roll over. And you can see that even with the latest data that's available, our gap above trend has started to come down. So maybe we are out of this thing. Maybe the second quarter is in fact the bottom of this recession or business cycle downturn, and then we do come out of it in the second half of the year. And with that, I'd be happy to take any questions that you might have.
Sure. Thanks a lot, Brian. I appreciate it. This is Tom Satino again. Brian, before we get to the questions of our members, I just had a couple of questions I'd like to ask you. Sure. Number one is on slide 16. We took a look at the market expectations of interest rates, and those yield curves that we see are really important to our members. The shape and ultimate level of interest rates really impact the net interest margins and bottom line earnings of our members. And as a component to our members' decision making, they look at what the expected direction of rates are. And you did mention that you felt that the Fed's monetary policy and our fiscal policy are going to be remaining accommodative for a while. Just wanted to get a little insight on what does a while mean, and what would you expect to happen over the next couple of years with regards to monetary and fiscal policy?
Well, I think the Fed probably is not going to be, they won't even consider changing the forward guidance until they're sure that we're out of this. And that may take, I mean, if you think about it, you won't see fourth quarter GDP numbers for this year until the beginning of next year. So, I mean, even if the data is getting better, they're going to take a considerable amount of time before they do anything. I think that what that does is that anchors the short end. I mean, if you think of the yield curve, you look at the short end where the funds rate is, basically put your hand on that. That's the Fed. The Fed's holding down that segment of the yield curve, and it'll be the longer dated issues, primarily, out to 2s to 30s, that will respond to what the economy is actually doing. I mean, they'll move in anticipation that the Fed at some point in time will have to raise rates. But again, I think given the magnitude of this crisis,
I'm sorry.
Given the magnitude of this crisis and given the job losses, I mean, to be fair, you may still be facing an unemployment rate that's north of 10% at the end of this year. That's not an environment in which the central bank's going to want to embark on any restriction of monetary policy.
Okay, so we're going to be at or below 0 to 25 basis points on short-term interest rates for the foreseeable future.
Yeah, and the longer dated issues, they'll react to what the economy's doing.
Okay. Well, I did one more, another question or two, Brian. Talking about, I was listening to a radio broadcast the other day talking about the 2008 crisis and how the impacts of that crisis are still being felt today. Now, this is hopefully a much more short-lived crisis. However, what do you think the economic fallout is going to be from the COVID-19 crisis over the next 5 and 10 years? And is there any permanent damage to the economy that we could expect?
Well, I think the possibility of permanent damage is entirely a function of how long this crisis goes on and how long it takes to get out of it. I mean, the quickest thing, the best thing for all concerned would be that we come up with a reliable remedy for COVID-19, or we come up with some sort of vaccine. I mean, I think that would turn things around very quickly. I think the thing is that even as we start to gradually reopen segments of the economy, it's going to take some time for segments like restaurants, hotels, and certainly airline travel to get back to where they were. So I think for those 3 areas in particular, the timing is important and how quickly we can turn this thing around. The other things that I think you need to think about is that, how do we look at policy going forward? I mean, it's pretty clear that after this thing, that healthcare policy, it's a matter of national defense. I mean, if you think about it, the hit to the economy in the wake of COVID-19 has been much more severe than anything we faced in any of these recent military conflicts that we've had over the last 10 or 15 years. So I mean, I think that healthcare policy basically is it's going to be incorporated in national defense policy, and I think everybody's relationship, all the economies worldwide, not just our own, I think our relationship with China is going to be altered as a result of this.
Okay, thanks, Brian. I know we're getting a little short on time. Alyssa, I see that we have a few questions from the audience. I would just like to field some questions now, Brian. Alyssa will pose those questions to you.
Sure.
Hi, Brian. Do you think that they will change SBA PPP to allow for proceeds to be used 100% for rent, utilities, cost to upgrade, to comply with new regulations rather than payroll?
I'm not quite sure about that. I mean, that may take some time before they would consider something like that.
Okay, great. And then there's been a lot of discussion about negative rates. What is your sense of the probability of a negative rate scenario? And what action would the Federal Reserve take to fend off such a scenario?
Well, I think the Fed has basically said that's an area that they just do not want to go into. And I would take them at their word. I think they're very serious about that. I think when they embark on these quantitative easing programs, if you think about it, it's precisely in periods in which a Taylor rule calculation would suggest that the federal funds rate should be negative. I mean, basically a negative federal funds rate, negative rates at the short end would destroy the money market industry. And I don't think the Fed wants to go there. But as an economist, I mean, the reason why I don't think negative rates are appealing is I'm not quite sure they do what they're designed to do. Basically, if you put in place negative interest rates, you're telling people that I don't want you to save, I don't want you to invest, I want you to go out and spend. And the negative rate experience of the Europeans and the Japanese, I'm not quite sure, support that. So I don't think you get much juice for negative interest rates. I think the Fed would be much better off, and this would probably be the next thing that they would do, is basically it's kind of akin to the Operation Twist that they used during the last crisis. What you do is you just decide that you're going to peg longer dated Treasury issues, and you basically bring down the whole longer portion of the term structure. That would be an easy thing to do. But again, I take them at their word, because I'm in agreement with them that I don't think negative rates do anything beneficial to the economy. So I don't even know why you want to go there. I mean, if you think about it on a personal level, if you have negative rates, you'd be better off putting your money in cash and putting it in either a mattress or a safe deposit box. Why do I want to lend you $100 to get 95 back at the end of the year? I don't want to do that.
Okay, thanks, Brian. Any other questions, Alyssa?
Yes, just one more. The Fed's balance sheet is growing dramatically. At one point, will their balance sheet be considered too big?
I'm not quite sure where too big is, but what we did learn in the last crisis is we peaked at around $4.5 trillion. They can rein it in once the crisis has subsided. Coming out of the great financial crisis, they basically ran some scenarios, and the median scenario was that they would permanently run a balance sheet of about $3.5 trillion, which they were able to bring it down to. And that was essentially where we were until the COVID-19 crisis began. So, I mean, does the balance sheet become a problem at some point in time? I think, that's part of another question. The question is, does Treasury issuance become a problem at some point in time? I think that's the question to ask. And there, I have to admit, I mean, I'm rethinking. I think a lot of the stuff that we may have learned in school, we have to rethink. The whole notion of, if there's an increase in government issuance of securities, that there's crowding out and that interest rates go higher. I mean, if you think about it, we've had a massive pickup in Treasury issuance, and yet we have lower interest rates than we had a year ago. I mean, I think the crucial point is going to be when people are demanding higher interest rates in order to purchase our debt. Or if, shudder to think you experience something like Germany has on occasion, where you have a failed auction. But I think as long as people are willing to hold on to our paper, we can continue to issue it. And I think basically the Fed balance sheet will go up along with that.
Okay. Well, thank you, Brian. I appreciate it. Thanks, everyone, for attending. We've come to, it's 11:45, so we've come to the end of this webinar. One thing I wanted to talk about is if you wanted to continue the conversation with Brian, as I mentioned earlier, he does quite a bit of speaking at our members' ALCO meetings, at their board of directors meetings, to discuss economic trends and forecasts. So if you'd like to arrange Brian to speak at your organization, please contact your relationship manager here at the Home Loan Bank and we'll set it up. Also, next week, same time, same day, 11 o'clock next Thursday, we're going to have another webinar titled Asset Liability Management Strategies for Unprecedented Times. That's going to be conducted along with Darling Consulting Group. Managing directors there will be on a panel discussing different strategies and tactics members can utilize to help boost performance during this time. And the two speakers will be Frank Ferrone and Joe Kennerson of the Darling Consulting Group. And last but not least, there is that survey at the end of this webinar. Please take a moment of your time. We appreciate if you give us a little feedback, and it'll help us develop content in the future and then offer other kind of educational programs. So again, thank you very much, and we look forward to seeing you again next week, Thursday at 11 o'clock. Okay, thank you, everybody.